Lovely to have you people. And nice talking to Mr. Sahu and Mr. Sorry, I didn't get your name from Bangalore. The other person?
No, Balaji, I'm from Chennai, I said.
Mr. Balaji. Yes. Okay.
Yesterday I didn't join. This is the first time I'm joining.
Okay. Very nice and welcome. Welcome to
Thank
all of you here. And it's so nice to see so many of you here. This was very interesting and is going to be very interesting as well. So let's start with the introduction. Today's topic will be property versus market. Where should your money go? This is the part 2 of what we had the last week. Okay, next slide, please. So the key takeaways for today will be comparative analysis of real estate versus stock market in terms of returns and risks, and understanding liquidity. How easy is it to exit each type of investment? Also, definitely the tax implications and benefits of property investments versus market investments. The role of diversification and why relying solely on property might not be ideal. Practical insights on building a balanced and resilient investment portfolio is what is coming up in today's session. Next slide. So about Get Set Up, for all you people who are new here, I'm sure most of you already know, but for the others, we are on a mission to help those over 55 learn new skills, connect with others, and also have wonderful, lovely experiences. Our goal is to reduce isolation, loneliness, and equip you with knowledge to age independently. Our community engages in classes online as well as offline, and most of you have already come and taken part in our offline sessions and travels as well. We have a travel coming up to Turkey in August, and yeah, looking forward to some really lovely travel coming up as well. Let me introduce Mr. Sridharan to the people who are before that. Let me just give you a brief on Franklin Templeton. Franklin Templeton is one of the largest asset managers globally. They have about 76 years of experience and currently managing assets to the tune of 1.58 trillion USD. And this is as of Feb 2025. It has been the part of Indian mutual funds industry for over 29 years. Franklin Templeton India offers a diversified bouquet of products spanning equity, debt, hybrid, and international funds, which may help the investors to meet their financial goals. They also have a rich history of being pioneers in many ways, like introduction of the concept of SIP, which is the systematic investment plan. This is in the Indian mutual fund industry. Their global parentage to local market expertise position them uniquely in delivering value to investors. So that's about Franklin Templeton. Let me introduce the speaker, Mr. Sridharan, who was also there last week. But for anyone new here, I would like to just tell you all a little bit about him. Mr. Sridharan is a recipient of Associate Financial Planner. He is a recipient of this Associate Financial Planner title for retirement planning and employee benefits for the Financial Planning Standard Board. He's also active contributor on personal finance magazines like Money Control, Financial Express, Times of India, etc. He's worked with Funds India, Quantum, Allegro Capital. He also has been 15 years as an independent financial advisor. He has conducted regular sessions on retirement planning across major PSU banks that include IOB, BOI, Indian Bank, Canara Bank, and many more. So he is very proficient in this particular topic, and I'd like to hand the session over to him. And all of you, please keep your questions ready. You can put it on the chat, or after he finishes speaking, you can always raise your hand. We'll take all of your questions as long as the time permits. Okay. Thank you. Thank you, Mr. Sridharan. Handing it over to you.
Thank you, Anita, for the brief introduction. So, good evening, everyone. Last week, actually, we discussed about the topic on property versus the market. See, basically, when we are talking about market, there are a lot of instruments that are available that also we discussed. So when we are talking about the market, so there are various instruments that was available in the equity market. One is actually, you can probably invest in direct equity, or you can invest in mutual funds, or you can invest in alternate investment funds, and then you can invest in PMS or REITs or InvITs. So these are the various, the alternate options available. Now we are going to, talk about in this session on the basically, why we are investing. Basically, we wanted to get a return on investment. So when we are talking about a return on investments, so which is actually, providing you a better return on investments, whether the property or the equity. That is what actually, we are going to discuss about the comparativity on both, comparative study on equity versus the property. So in the last 15 years, how the equity market has performed compared to a real estate market, and 20-year performance or a 25-year performance. That is what the comparative study, that we are going to discuss. See, basically, the key differences between real estate and equity shares. The feature is basically, in terms of real estate, you have a physical property. Either it might be a residential property or it might be a commercial property. On the other side, when we are talking about equity shares, you become a owner of the listed company. So you become a part owner of the listed company, and the capital requirement in terms of real estate is between 50 lakhs to 1 crore is the typical investment that is required. And here in terms of equity shares, you can slow and steadily invest. The lowest investment that is required for investing in an equity mutual fund is about 5,000 rupees, and there is no maximum amount that is required. So slow and steadily one can build the corpus in terms of the equity shares or even equity based mutual funds. That is something one can look at it. When we are talking about the liquidity is very low in terms of real estate investments. And when we are talking about equity shares or equity mutual funds, the liquidity is immediate. It is actually, it can be sold in the stock exchange when we are talking about direct equity shares, and you will receive the money within 2 working days. Similarly, when we are talking about mutual funds, the liquidity is very, very, immediate. Maybe, in 2 working days, you will be receiving the funds. So from that perspective, liquidity also is easy in equity shares, but it is very low in terms of real estate investments. So when we are talking about management efforts, so management efforts in the sense, maintenance and legal and tenant management, this is actually, something, the management effort is very, very high when we are talking about real estate investments. And on the other side, equity shares, it is very low because, you are actually, going to give it to a professional who is basically going to do the research, and then they are going to monitor the performance of the equities. So from that perspective, the management effort on real estate is actually very high, and on the equity based investments, any equity based investments, the management is very, very low. And the other key differences between the real estate and equity shares, see, when we are talking about equity investments, the capital required is, as I said, 50 lakhs to 1 crore. And this will probably provide you a rental income of 2 to 4%. 4% is on the higher side, but 2 to 3% is the returns on the rental income. But when we are talking about the equity shares, so the entry barrier is lower, and you have the capacity of earning higher returns over a long period of time. And also on the other side, the equities, basically, if you are investing in equity shares, you will also be, getting income in terms of dividends. So the dividends might be ranging from 2% to 5% or 6% is what actually the dividend income one can receive apart from the capital appreciation. So when we are talking about real estate versus equity, real estate is providing a rental income, wherein equity shares are providing a dividend income. That is where actually it varies. And other than that, if you look at the last 15 years and 20 years and 25 years performance on the real estate versus the equity shares, we are just talking about investing money in Sensex or Nifty 50. Assuming, over a period of 15 years, the real estate has typically delivered a return between 7 to 12%. On the other side, the equity has delivered between 12 to 18%. So the performance gap, itself is very wide. When we are talking about 7% return on the lower side, when we are talking about 15 years or 20 years, 25 years period, it has delivered about little higher return. But on the overall perspective, your equity has delivered almost 75% higher than your real estate investments. So that is what actually the historical return shows. So from that perspective, yes, you can consider investing a portion of it in uh, the equity. So how equity is beneficial? So basically, again, we have done a comparison on tier 1, tier 2, and tier 3 cities. So basically, when we are talking about real estate investments, tier 1 cities will be, giving you higher return because of urbanization and high demand and limited supply. Because of that, if you look at the tier 1 cities like, Mumbai, Delhi, or Bangalore, or your Chennai, all metro cities typically, used to give about 10 to 12% CAGR over a long period of time. When we are talking about tier 2 cities, so the demand is actually, these are all emerging business hubs, but the infrastructure facilities are lower and it is all growing. Let us look at, Pune or Jaipur or some emerging, cities. There actually, the comparative returns on the real estate is in the range of 7 to 9%. And tier 3 cities, the overall long period of returns, basically the entry cost is low, but the return also is low in these places. It is actually ranging from 5 to 7% is the return one can expect in the tier 3 cities. So 15 years of example, we have just considered 15 years of investments. Assuming, one has invested 50 lakhs in the real estate, assuming somebody has purchased 50 lakhs apartment in a Mumbai, that is a, tier 1 city. By 2009, if somebody would have purchased, 50 lakhs of apartment in Mumbai, it could have grown to 1.5 crore. It has delivered about 10% CAGR in the last 15 years. But again, they could have got a rental income of, let's say, about 3% yield, which is about 25,000 rupees a monthly rental income. So including the rental income and the property growth, for the last 15 years, the total value, including the rental income, would have been close to 2 crores. But wherein the same 50 lakhs is invested in the Sensex, about 15 years back in 2009, the Sensex was at 9,000, basically, so if they would have invested in Sensex, the present value they could have got, does anybody guess what could be the amount?
10 times, 5 crores plus.
5 crores plus. Exactly. So it has delivered about 14.5% CAGR. So it has given actually, the current value, if somebody would have invested in 50 lakhs in Sensex, so by this time, the current value would have been 3.5 crore. And also on top of it, actually, it could have given a dividend of 1 to 2% annually. So overall income, including the dividend, it is almost, it is at 4.2 crore. So when we are talking about direct equity shares, we are not talking about, investing in specific equity. We have just compared only the Sensex. What is the Sensex return when we are talking about investing in Sensex versus the investments in real estate that is the residential property one bought in Mumbai. So here the return itself is double. So between equity and real estate, this is actually is a past performance of real estate versus the equity shares. Same thing, when we are talking about 20-year, somebody has invested 25 lakhs initially capital in real estate. So capital in real estate. So it could have been 1.2 crore by this time, assuming, in Bangalore, if somebody would have invested 25 lakhs, it could have delivered about 11% CAGR. So overall, 1.2 crore is what the present value of the apartment could be. And if they would have invested the same 25 lakhs in a Sensex, so it could have delivered 16% return, and the present value would be how much? It could be 3.8 crore, which is actually, 2 times higher than the, the returns one has got from the property. So this is actually is the comparison on real estate investments versus the direct equity investments. So when we are talking about the risk, so when we are talking about the risk, we already discussed about this risk already, but again I'm just repeating this. So when we are talking about the market volatility, real estate, we are not going to check the prices on a daily basis, because there is no proper index available to track the value. So when you bought the property 5 years back, these are all values which actually being quoted in common. When you go and check reality, when you are just given an advertisement, or maybe you can just tell them that you wanted to sell the property, then only you get to know the real value. So, and hence we are all having a mental mathematics. We have a bias in terms of this property might be going at this level. So even when they are asking, assuming you bought a property for 50 lakhs, and assuming the market value of the property, you are presuming that it is 75 lakhs. When you are trying to give an advertisement for selling the property in real time, people might be asking for little lesser amount than what you are quoting. So they might be asking for 60 lakhs or 65 lakhs. So you fix the price, because the fixation is being happened from your end. There is no real time value of real estate is available. Only if you go to the registration department, there could be some what do you call the guideline value and the market value. All these things are very complex in nature. So from that perspective, we may not be knowing the real value of the property. On the other side, here actually, the equity market is very, very high in terms of their price fluctuation. This high volatile during the day. See, basically, even during the day, the prices might be, fluctuating. We will be looking that, and then, we get a kind of, the emotional bias towards the prices that are fluctuating, because that is when you are looking at the screen, this is only the notional value. When you basically liquidate it, you are realizing the gains or profit. So from that perspective, you look at the present value, present market value that is actually taking on a dashboard. With that only you are attached with it. So it is highly volatile, and liquidity risk, of course, the property has higher liquidity risk, wherein equity has lower liquidity risk, and then the regulatory risk. So regulatory risk is moderate in terms of real estate, because the RERA, and then the after 2018 actually RERA has become the part and parcel of the real estate industry. So the regulatory perspective, it is very moderate. And in equity shares also, it is being moderated by SEBI. So there is a regulator in place in both in terms of real estate and equity. So basically, this is actually, something which is basically being implemented by the government. And the tax changes also, is a regulatory risk that one has to go through. Sometimes, the registration cost might be varying from one city to another city. That's all depends on the local government. Actually, they take the call. And secondly, the long-term capital gains and the short-term capital gains keep changing from time to time based on the budgetary announcement. That is also the risk one carries both in terms of equity and the real estate. So when we are talking about liquidity comparison, when we are talking about equity, you decided this day I wanted to sell, you just place you place the sell order in equity, and you sell the equity, and the money will be deposited in your depository account, and then you can liquidate it after 2 working days. So it requires only 3 days to liquidate your money. Wherein in the real estate, you just begin the property selling process. Might be you might be or informing your relatives, or you might be listing that in the website or in the newspaper. The day one the listing starts, and then it takes about 4 to 5 weeks to get a kind of an inquiry, and then seeing the property, and then you know it is one month it takes for you to get proper leads for selling the property. And then even if somebody is interested, it takes about another 2 months time for you to complete the property sale, because of they are having cash, or if they are having they are planning to take up a loan. It all depends on the sale that is happening. Only the realization happens 6 months later. So completing the end-to-end process of selling a property, it requires minimum, I am telling about the minimum time requirement for selling a property. It takes about a 6 months period, wherein on the equity side it is only 3 days to liquidate the investments. So that is the key advantage uh, you have on the equity investments. When we are talking about the management effort, so when we are talking about managing the property and managing the investments, so equity investments requires minimum effort in terms of monitoring. So basically, equity investments, you are going to give it to a professional who are going to manage it, and you are going to just monitor it from time to time. And then when we are talking about property maintenance requires a moderate effort. It requires, you have to identify, something goes wrong, you have to fix it, you have to identify a plumber, or the carpenter, or anybody. You have to do the maintenance, which takes a little efforts. And then when we are talking about legal compliance and documentation, it requires significant efforts. So that is when it is talking about property, it requires a significant effort, and maximum effort is required for tenant management. So when somebody goes out and identifying the tenant, and then supervise the tenant, and whether the tenant is good or bad, you have to do the background check, all the due diligence, all these things are the maximum efforts that goes into identifying the good tenant, and rent collection also is a huge significant management that is required. So from that perspective, again, which score better is equity, is scoring better. When we are talking about the taxation, so the real estate taxation is basically, when we are talking about long-term capital gains, the long-term capital gains, are taxed more than 2 years. It is actually, it is coming with 20% along with indexation. So when we are talking about the rental income, so the rental income will be taxed at the individual tax slab. And there is one clause that is available where you can negate 30% of the 30% of the rental income for all your maintenance expenses. So that is something one can negate. And also one can negate the annual taxes, that they are paying. That also can be negated on the on the capital gains. And then when we are talking about stamp duty and registration, so there is a one-time payment which may be ranging from 7% to, or typically, it is ranging from 5% to 9% or 10%, depends on the state tax law. So depends on the state tax law. It may be ranging from 5% to 11%. It all depends on the state. When we are talking about equity taxation, so the basically, the long-term capital gains, anything over and above 1.25 lakhs of profit in a year, which will be taxed at 12.5%. So the taxation is, yes, of course, 12.5% is what one has to pay. It is irrespective of whatever the tax slab you are in. So it might be, you might be in 30% tax slab or 40% tax slab, or irrespective of any tax slab, one has to pay 12.5% as a long-term capital gains. Any period more than 1 year is considered to be the long-term capital. On the short term, anything less than 1 year, it is considered to be the short-term capital asset. They will be charging at 20%. Anything less than 1 year, they charge at 20%. And then the dividends are taxed at the individual tax slab. It will be added to the individual's income. Based on the individual income, actually, they have to pay the taxes. Apart from that, there is a security transaction tax of 0.1% of the investment. They will be deducting security transaction tax. This is called as STT. These are the taxes, that are available between equity and the real estate. And other key advantage between real estate and equity is basically when we are talking about the real estate, we will be able to invest in one or two properties. So it is actually, the diversification is not there. Basically, we are limited to one location, or maybe if you have multiple properties, maybe few locations with high capital inflow. So a lot of capital has to be, invested in buying two or three properties. When it is coming to equity portfolio, you can buy, many number of companies. So the diversification potential is very high in equity. And then multiple asset classes also can be brought through equity. So if when we are talking about equity investments, you can buy international equities, you can buy Indian equity, and then you can buy maybe you can buy other commodities. Commodities in the sense, you can buy gold, you can buy silver. These are the classification and diversification that are available in equity investments compared to real estate. Real estate is only one asset class, and you will be buying one property. You are dumping the entire money in one single property. So, which carries huge risk. So, on the risk mitigation, diversification is always a better, better, avenue when we are talking about equity versus the real estate. And then when we are talking about mutual funds, so again, between equity and mutual funds, equity, yes, of course, you need to have time, money, and knowledge. All three things are required. So of course, you might be having money. That is the reason why you are investing. Second is actually, since if you are all working professional, it will be very difficult for you to find time to do the research, do the analysis, do read the company balance sheet, do read the fundamental of the company, do read the sectors, which is very difficult for individuals who are working professional, or even if you gain knowledge, identifying, buying, selling, and monitoring will be very difficult. So that is second, and third is knowledge. So knowledge also, it is very difficult. It is always advisable to associate with an advisor who provide you a proper advice. So from that perspective, equity carries a little risk in terms of research and management. That is reason why you should look out for either mutual funds, or maybe you can look out for people who are providing a right equity advice. So you need to sign up with an advisor who will provide you the right advice. When we are talking about the professional management, mutual funds are the one which are basically being managed very professionally. Assuming the mutual funds in the last 20 years. So assuming somebody has invested 1 crore in 2004, we are talking about a 20-year comparison of 20-year comparison of mutual fund investments versus the real estate. So 1 crore invested in 2004 in real estate. So it could have delivered about, assuming 10% CAGR. It has delivered. It has the value right now. It is 6.7 crore. 1 crore has become 6.7 crore in the last 20 years. Any guess on the same 1 crore invested in the mutual funds in the same period, 20 years? Any guess? 1 crore invested would have been how much by this time?
Probably 2.5, 3 times at least. Let's say around 18 to 19 crores.
18 to 10?
About 10 crores.
10 crores, exactly. So basically, when we are talking about the last 20 years, the market has delivered 14% CAGR. I'm talking about the mutual funds. Okay. It could have been 13.7 crore, which is almost like, double the return of the real estate. So the mutual fund also has outperformed the real estate. So basically, the power of compounding will be available in mutual funds because, the initial year, it is a time of accumulation. And after some point in time, it starts, the compounding. The compounding effect will be more in mutual funds. And mutual funds are the one which are basically being professionally managed. And also, the risk mitigation basically being there because it is being diversified. Because if you invest in direct stocks, you are again married to a company, wherein here there are professionals who doesn't have any bias towards the investments. When we are talking about money, we are all emotionally connected, so we always take a decision based on our mental bias. Wherein if you leave it to a professional, they don't have any bias, but they look at the process. They look at what is right, what is wrong. So based on that, actually, they will be taking the decision. So they have a research methodology. They identify stocks that are going to do well in the future. So there are various the research that they do. Based on that, actually they take the decision in terms of where to invest your money. So from that perspective, mutual funds are the one which are basically providing you diversified investments, and also which is basically being managed very professionally. And then when we are talking about alternate investment funds versus real estate, so we discussed about direct equity versus the real estate, and then mutual fund versus the real estate. And then now we are going to discuss about the alternate investment funds versus the real estate investments. So when we are talking about alternate investment funds, so the CAT2 funds, basically, the alternate investment funds require a minimum ticket size of 1 CR. So 1 CR is the minimum minimum investment requirement. This is matching up with real estate. Now, if you look at any of the tier 1 cities or even tier 2 cities, the minimum, investment that is required to buy a property, a good, decent 2 BHK property in a good city like, Chennai or Bombay or Delhi, or tier 2 cities like, Pune or, Hyderabad or any other place, it requires a minimum capital of 1 crore. So if you invest 1 crore, you get, basically you get the return on investment is one is actually, you get the rental income and there is a capital appreciation. When we are talking about alternate investment funds, they will be investing in private equity and debt funds. That is Cat 2 investments. And Cat 3 investments is basically, they will be investing in hedge funds and high risk strategies, which requires a capital investment of 1 crore. So both AIF and this one, the real estate, if you invest over a period of, let us say, even alternate investments, basically, requires a lock-in period of 5 to 7 years. That is the minimum lock-in period. Some of the hedge funds, long-short strategies might be having a 2 years of this one, but typically most of the alternate investment funds have a lock-in period of 5 to 7 years. So basically, assuming risk and volatility, when we are talking about risk and volatility on real estate versus the AIF, as such, the real estate is basically low volatility, and it is also, very, very high in terms of, liquidity risk that is there. And then leverage risk also is there, and then regulatory risk is basically, it is being governed by RERA and the tax changes. That is also the risk that one has to carry. When we are talking about AIF, so the market volatility, yes, of course, when we are talking about category 2, so it is actually, the sectoral risk is there. And liquidity risk, yes, as I told you, it carries 5 to 7 years of lock-in period. That risk one has to carry. And then it has got low leverage risk. Basically, you cannot leverage your AIF investments against taking up a loan and then investing in something else. That is actually not possible with AIF category. And regulatory risk is moderate regulatory risk because it is being governed by SEBI. There is a regulation which keeps kicking on from time to time. There could be some changes here, there, everywhere, and also the taxation changes and other things, which will be which will probably hit your AIF. When we are talking about category 3, this is actually high volatility because it is linked to markets. Because these are all investments which will be invested in, they will be investing in hedge funds and other things which carries high risk. But liquidity again, there is moderate, liquidity because of it is market linked, and the leverage risk also is there. Basically when we are talking about Cat 3 funds, they will all be taking higher leverages. The leverage risk also is there with AIF. So between real estate and alternate investment funds, if somebody wanted to have tangible assets, one can tangible asset with physical ownership, one can look at real estate. But if somebody needs basically, can commit a capital of 1 crore with a period of 5 to 7 years, and then they can diversify among various sectors, they can look at alternate investment funds. So from the overall perspective, the alternate investment funds or a PMS or your equity, or even when we are talking about the equities or mutual funds, which carries the high liquidity and other risk. Basically, you have real estate carries higher risk compared to all the other asset classes that we are talking about. When we are talking about the impact of economic cycles, when the economy is when the economy is booming, then when the economy is booming, then your equity market could deliver a high return. Equity market could deliver a high return because the corporate profits will surge, and that will actually give you the robust growth in terms of equity returns. When the economy is slowing down, when the economy is not doing well, your equity market may not be doing well because the corporate earnings may not happen the way how it was supposed to be. But when during the high inflation times, when the inflation is on the higher side, the real assets will tend to do well. So when the interest rate, when the inflation is on the higher side, basically, the real estate and the gold could tend to deliver higher returns. But when the interest rate is also on the lower side, when the interest rate is at 6% or 6.5%, people wanted to take a leverage because typically the properties used to deliver about 10% return. 10 to 12% is what the return one can expect on the property. When the interest rate is at 6.57%, people wanted to take a leverage. They borrow money at 7%, and then they buy a property which will deliver about 10% return. So this leverage basically might be, the short-term interest rates only will be there at 6 to 7%. Typically, the interest rate cycle will change over a period of 3 to 5 years. That is the cycle. So within 3 to 5 years, if somebody, borrow money and take a leverage and then repay money within 3 to 5 years, then probably one can invest in property. So other advantage with equity investment is actually, as I earlier said, they can also take a global exposure. If they are looking at investing, buying, the Google or Apple shares, they will be able to buy through their equity. If they wanted to buy something from Taiwan, if they wanted to invest something in African countries, or if they wanted to invest in China, Australia, whichever country, so they will be able to participate through equity investment. So that is the key advantage of the equity investments. So next is actually, when we are talking about the overall asset allocation. So is that property is the worst investment? I don't say property is not a worst investment, but one should follow the asset allocation. What is the asset spread one can follow? Basically, they can have about 20% allocation towards real estate in terms of residential property or commercial property that they can go, and then they can have about 50% allocation towards equity investments, and then about 15% investment towards alternate investments, and then about 15% investments in REITs and InvITs. So this is the asset allocation one can follow.
Mr.
So that,
Sridharan, just sorry to interrupt you. We just have about 12 minutes. We
No,
have to take the
I'm
questions
completed.
as well.
I'm done with. No.
Okay.
I'm done with.
Great,
So
great.
this is the conclusion. So basically, one can spread their investments across the asset classes between real estate, alternate investments, equities, and REITs and InvITs, so that the risk is being mitigated. That is the conclusion that I wanted to say. So with this, I am concluding. Any questions? I am ready to answer.
Okay, let me just start taking questions from the chat. Mr. Yuvraj, I'll start it with him because I think that's the first question. He asks, tell me the NPS or UPS, which is better?
So earlier, actually, unified pension system was there in India, and then after that, it was basically being removed in 2004, I believe. So they have introduced NPS. Last 20 years, people were getting only investment in NPS. Now, actually, in the last budget, I think they are reintroducing the UPS system. So UPS system would be the good because you get a defined pension, where in NPS there is no defined pension. So it's all depends on the growth that is happening on the investments is what actually you'll be getting as annuity. So from that perspective, it is UPS will be the better option.
Okay, the next question will be, how much stamp duty is to be paid in Mumbai on registration of new flats or resale of flats? Who has to pay, buyer or seller?
I am not really aware of, because they have to just look at the state law, and they have to approach the corporation and then find out what is the stamp duty on resale of flats.
Um, okay, then liquidity. Okay, if you receive an X amount by selling a property and then you buy a new property within less than a year, how much tax has to be paid?
Can you repeat the question?
Yes, if you receive an X amount by selling a property and then you buy
Okay.
a new property within less than a year, how much tax
Right.
to be paid?
See, ideally, when you sell a property, 1 year time for buying another property is given. There is no tax needs to be paid because assuming if they are selling a property worth 1 crore and then selling another property with 1 crore, if that matches, no need to pay any tax because it gets adjusted. Selling the property and buying another property, so there is no tax that needs to be paid. If it is under construction property, they are giving 2 years or 3 years period so that they can slow and steadily pay. And if it is more than 3 years, they can put this money in if it is more than 1 year, they have to put this money in a capital gains account and they can buy the property within 3 years period. So that means typically 3 plus 1 is 4 years is what actually one can avail. So they cannot access this capital gains money because that has to be allotted for buying property. So one has to approach the bank and ask them to open a capital gains account.
You said capital gains account. So what is capital gains account?
Capital gains account is a separately identifiable account which will be opened in most of the nationalized banks, and you will be able to take out money only for buying property. You cannot take money for other things.
Okay, yeah. Minnie, you can unmute and ask your question. Minnie?
Yes, I have two questions. Like first one is that we were investing 50,000 in NPS, but in the new regime, is that still viable or no?
That is still applicable. 50,000 one can invest in the
But are we going
in
to
the
get
new
rebate
regime.
in the new regime? Are we going to get rebate of it when we invest 50,000 in NPS?
Yes.
In
NPS
the
is still applicable. 50% of 50,000, that is 25,000, is applicable.
Okay. And my second question is like if we sell a property and we do not want to buy another property, then which option is better? To invest that money in capital gains or to pay tax?
See, basically, if you are you wanted to hold this money for next 10 years, I will suggest you, there are about two options. One is actually pay tax, invest in mutual funds. If you wanted to hold on for, let's say, about 7-10 years, which will yield you about 10 to 12%, which will compensate the taxes that you paid. That is option one, number one. Second option would be if you don't want to pay capital gains to the extent of 50 lakhs, you can put this 50 lakhs into a capital gain bonds, which will be 54 EC bonds that are available. The 54 EC bonds that are available, which has got a lock-in period of 5 years, and they provide 5.25% interest at this moment. But the interest, whatever you receive, will be added to your income, and based on your income tax slab, you have to pay tax. So this is another option that is available. So pay to the extent of 50 lakhs as capital gains in the 54 EC. The rest of the money, actually, you do whatever you want. Whether you want to invest or you want to, spend that money, whichever way you.
Okay, one question, Asha Gala. When a residential property in Mumbai is of Pagdi system, where cash transactions would happen while buying and the tenant is given only rent receipts, how does one account for the amount received after paying the landlord's share?
See, basically, I am not aware of the Pagadi system. Typically, any cash component you receive, you have to account for it. And if you don't account it, then probably, the tax laws are applicable, one has to face the consequences if one is getting caught.
So another question is where to invest our hard-earned money in today's scenario. Also, how to control emotions while purchasing a house or investing in mutual funds.
So this is a separate, emotional bias. It's
Yes,
basically is a separate, session that we can conduct
correct,
actually.
correct.
So what are all the different biases, people have, and how to overcome those biases is something, which we can take it as a separate class itself.
Yeah. And then what happens to tax angle when you sell at less than RR rate?
What is RR rate?
I'm not very sure. Ready reckoner rate.
When we are selling at
Ready
lesser
reckoner.
than. See, normally, the registration office are not allowing anything less than the ready reckoner rate. Okay, so if they are selling at a lower price, then they will have to account it for the ready reckoner rate that is available in the corporation or municipal office.
Okay. Approximately how much stamp duty is to be paid while purchasing a flat in Mumbai?
This
But I
question
think
is
it depends
repeating.
on the size of the flat, right?
I am not sure about the Mumbai law.
Yeah.
So
Okay. Next is simply lifelong home for comfort rather than only investment. Shall we view real estate as simply lifelong home for comfort and shelter rather than only investment?
see, for the living purpose, one has to have a home, no doubt about it. That is not considered as an asset. That's actually, it is being consumed by us. So we will not consider that as an asset.
REIT, is it good compared to
Yeah.
regular real estate?
Yes, a rate is good actually, because it is just a developing space in terms of real estate. So rate is good as an investment.
How to choose a good mutual fund? After all, there are good and bad ones.
You have to basically do the analysis by yourself. You have to do the due diligence or take the help from the advisors.
Okay.
Advisors are the one who are doing day in, day out on due diligence in terms of, selecting the right mutual funds.
Okay. Mr. Sahu, you can raise your hand and I can unmute you. If you want to ask a question still, you can. And then there's another question. Is liquidity by investing in mutual funds better or buying property if you sell a house?
Mutual fund is always better because it is 3 days liquidity. Property, we may not know.
Right. So, Mr. Sahu, do you still have a question? You can raise your hand, please. Okay, Mr. Sahu is there. Yeah. Okay, okay. Tina, can you unmute Mr. Sahu, please?
Yes, ma'am.
Okay,
Yeah.
I am unmuted.
Yeah.
Actually, I've got one point. The real
Yes,
estate
please.
has actually two components, the land component and the building component. The land component is the one that really appreciates. The building component depreciates. Now, for example, the place where I live in now, buildings were constructed 25, 30 years back. Now, developers are buying those where there was one unit, they are demolishing the building and making some 6 or 8 flats. So it is the land is the one which appreciates in real estate. Building
Yes.
depreciates.
Yes, that is true. Land is the one which appreciates. Even when we are talking about real estate, nowadays actually, the land scarcity is very huge, and because of urbanization, the populations are moving from rural to urban. So they need more place to live. So instead of having a wider space to live, they are actually raising apartments. The skyscrapers are coming into place only because of the landscape is available is limited. That is the reason why always the land price will always increase higher than your this one, your building value.
Thank you, Mr. Sridharan. I think we've just managed to finish it right on time. Thank you, everybody who joined us here today. That was a really fantastic session, super informative. And please do get in touch with us. Abhijit just put the link on the chat. And if you guys want to have any more information, any more sessions like this, please do get in touch with us. We'll be more than happy to have more sessions like this arranged for you. Thank you very much and have a good evening.
Yeah. Thank you. Thank you.